Good morning, everyone. Welcome to the first panel of Spears 500 Live 2024, which is on wealth management and held in association with Multrees. This morning we've got a lovely panel to dive into this topic. On my left we have Charlotte Thorne, a founding partner of CapGen, a leading London private investment office with 3.5 billion in assets under management and clients including the Heineken family. Next we have Ross Elder, who you'll know as a twice winner of a Spears High Net Worth Asset Manager of the Year Award in 2018-2023, and the founding partner and managing partner of Lincoln. Next, we have Grant Parkinson. I'm about to fall over my words. Grant was formerly head of Wealth and Retail Banking Europe at Standard Chartered, and now is Global Head Transformation and Strategic Initiatives Wealth and Retail Banking at the bank, which has 84,000 members of staff and banks in 53 territories at last count. So there's nothing Grant doesn't know. And finally, in the blue corner, we have Ian Woodhouse, who's the strategic advisor at Multrees, an outsourced investment services provider, which was founded in 2010 and now serves 24 wealth management clients with 14,000 end customers. Please welcome our panel. So we've got half an hour before we turn to questions from you. You can ask questions via Slido or the old-fashioned way through the roving mic. Hello over there, sorry to ignore you so far. We've got three things on the roster: from consolidation to consumer duty, the forces shaping the evolution of wealth management for ultra-high net worth clients in the UK. We should really have added Rachel Reeves' name to that list. But first, let's begin with consolidation. Ian, over there, all the way over there, can you give us an overview of what you're seeing in the industry from a consolidation perspective?
Okay, thank you. So consolidation, I think the first thing to say is that the wealth industry is the most fragmented sector in financial services in the UK today. You have about 5,000 IFA firms, you have about 1,000 or so family offices, and you also have somewhere in the region of 300 private client investment firms. So, it's a very fragmented industry, and so consolidation is on the agenda of most of the players. Now, consolidation is not the only strategic posture. You can go for organic growth in this market. It's still growing. You can also adopt a more partnership approach to expansion. So staying with consolidation, what's actually happened is that the pace of consolidation has increased, certainly in the last 10 years. I would say traditionally consolidation has been by one private client firm buying another private client firm, or a private bank buying another private bank. And we've seen a lot of that recently. We've seen RBC Bruin. We've seen also, you could look at Rathbones and Investec and Investec Wealth. But what's happened, which is new in our industry, is the rise of private equity investments. And it's difficult to know how much of the industry private equity controls, but it's probably somewhere in the region of around 25%. And so private equity has made a significant impact. But things may be changing. Private equity is, like all of us, under increasing pressure from rising interest rates. And so consolidation going forward may be in a different form and shape. So most private equity firms now are becoming more hands-on investors in order to restructure companies because of the high cost of their capital. So I think in summary, I think what we're seeing is a shift in the pattern of consolidation. I think it will be a continuing role for both existing firms and also the private equity. But we'll also probably see new investors, maybe more longer-term investors coming in to restructure the industry and help it consolidate a bit. Those might be pension funds and so on and so forth. And if I go back to where I started, you know, if you're a chief executive or leadership team, you've probably got these three options. One is, you know, are we going to be a consolidator? Will we participate in that? Secondly, are we going to focus on organic growth? And thirdly, are we going to operate more in a partnership and ecosystem and network model? And I think our view probably is the partnership, the ecosystem, and the network model is the one to watch, because that's going to rise, I think, quite considerably given the fragmentation we currently have in the industry. So
Brilliant.
I'll leave it there.
Thank you very much. That's super. Okay, Charlotte, let's turn to you. From your corner in Berkeley Square, what are you seeing in consolidation? Has it been speeding up, and why do you think people are doing it?
Yeah, I think there's a lot of consolidation in our industry. We've certainly seen that, and today we've had, not quite in our industry, but the private equity news about Hargreaves Lansdowne. So clearly there's appetite, and you can see why there's supply as well, because it's actually extremely expensive to run a slightly smaller than average business. So you can see why people, after a certain number of years, decide to throw in the towel and perhaps take the private equity money. But I think those of us who work in this industry will also know that there's been a lot of private equity activity in the trustee sector, particularly in the Channel Islands. And so there's been a lot of consolidation there, and I think you can look to that as a model for what's happening, or what potentially might happen in our sector, which is you see a lot of circulation and a lot of movement in those sectors. You wonder how much any of this is useful for the end client. And I think in a very service-focused industry, as the trust industry is, and as our industry really ought to be, and I know we're going to talk about consumer duty later, you wonder where those additional profits for the private equity industry are going to come from. Because, I mean, one of the things I always say about our business is the investment management piece of it is quite scalable. I don't say that really to the investment team, but that is how it is. The client service bit is not scalable, and we sort of quite deliberately have built a business that has a not scalable aspect to it, because if you're interested in client service and you want to do it in a certain way, it's actually about people, and that's expensive. So I just wonder where the private equity model is going to take our industry, and I'm not sure it's helpful for clients.
So you're a consolidation skeptic, I can tell. So Grant, let's turn to you for a global perspective on consolidation, if you would.
By all means. So I think very much echoing what the other panelists have said. So look, obviously, point of fact, I think wealth management continues to attract very high multiples. And if you disaggregate and look at large universal banks, the wealth revenue streams within that attract higher multiples than the other business lines. However, at the same time, and echoing very much what Charlotte said, it is expensive. And so operating at scale is a challenge. And you will absolutely see, again, large banks that, in particular who've got into particular geographies, given it a go, and have they built scale in a meaningful time frame to see returns coming. Where they haven't, we will see exits. So, I think you will absolutely continue to see those deciding that they're going to be aggregators, as we've discussed, and pull some of these businesses together. And those who haven't managed to achieve scale and are saying, goodness, for the level of services that our clients are looking for, I'm sorry, but we can't deliver that at the scale required, and they'll look to divest particular business units in particular geographies.
But generally speaking, are players in wealth management getting bigger in order to achieve the same levels of profits, given squeeze margins and everything else that we know is going on?
I think they must, because unless they can find other ways of delivering services, and I think the partnership model that Ian alluded to is one way to do that, it is expensive to operate, and so you must hit a particular level of scale. Unless you have partners who can perhaps perform some of those parts of the value chain for you, that enables you to operate at perhaps a smaller scale than others.
Okay, brilliant. So now let's turn to you, Ross. You're at Lincoln, you're a boutique. Are you interested in being consolidated?
No, we don't want to be consolidated. I clearly see the benefits of consolidation. There is ongoing fee pressure to bring those fees down. There is, as we'll talk about later, greater regulation and compliance with higher cost. But my feeling is that the consolidation is really for the benefit of the investor as opposed to the client. So we've set our firm up, we only have the team and 17 of our clients as shareholders. They're not looking for us to drive economies of scale or deliver efficiencies or hit quarterly targets, just to do our day job as well as we possibly can. Now, we're privileged to partner with Multrees, which does help us in a number of areas. And we've also founded something called the Private Office Forum, where a number of our competitors meet on a regular basis, and we look to see if we can support each other that way. So I do see it as something that will continue. I have to say, I'm not against consolidation. If you'd asked me 10 years ago who the best of our competitors were, I might have said Cazenove, Hoare & Co. and Schroders. And fortunately, we only have to compete against one firm rather than 3 firms now. So it will continue, and I think it is a direction of travel. But as Charlotte says, when you are looking for a very high-end personal service to high-net-worth private clients, then I think that is about treating things as an individual and not necessarily about trying to scale up.
Well, you make a good case for small is beautiful. So let's put this question to all of you and keep the answer snappy, because we've got so much more to talk about. But is consolidation a good thing, Charlotte?
Not for consumers, no.
Can't expand.
snappy enough?
You can expand a bit on that. Go on.
No, I mean, I think it has just been said that this is, at a certain end of the industry, not all across the whole industry, but at our end of the industry, this is a high-touch business. And it is fantastically expensive, and the challenge is to bring the right people into the industry and grow the team and all of that. And consolidating can take out, can help you by taking out cost. Well, we love to take out cost, but that means taking out people. So I don't see how that, in the end, helps the consumer. The other aspect to it, of course, is competition is what we're supposed to be achieving. And I think we alluded to some of this earlier on in the talk about free markets and global politics, which is slightly above my pay grade. But if we're looking for competition, consolidation is not the way to achieve that.
And obviously, as you move on to the topic of consumer duty, we can look at that as well. Ross, what do you think? What do you make of the? Is good or bad thing for the industry as a whole?
I think it's difficult to call it good or bad. I think, it is a fact of life and it will continue, and there's a lot of areas where it needs to continue. But I wonder if the question from our perspective is not necessarily about consolidation, it's about ownership structure. So when you have a business that either has huge numbers of external shareholders or is private equity backed, then I wonder if the focus is on the best outcomes for clients. Perhaps you could see, even in our space, some more mergers, but if these firms remain independent and put the client first, then I don't see there's necessarily a negative about increasing size.
Okay, but as someone who represents a firm that is anti-consolidation, when confronted with increased costs, which everyone on the panel would agree are a fact of life and doing business, how do you maintain the level of profit to which you and your yacht-owning friends would be accustomed to?
I think we need to continue growing. So we need to continue to deliver a good service to our clients. And as a firm, we don't advertise or cold calls. Everything's been built through referral. So the reality is we just go back to focus on our day job, which is delivering excellent service, trying to deliver performance. And if that happens, then our client base, we've been very fortunate, continues to grow. So that is how we focus.
So animal spirits is,
yes.
is your... Okay, brilliant. Grant, consolidation, good thing, bad thing?
It is incredibly hard to keep this snappy. So I'm going to go with, and we're about to talk about consumer duty, but we won't stray there now. But consumer duty encourages us to be very clear on who our target markets are. Depending on what your target market is and depending on the business model you've got, you might need to be bigger in order to serve those target markets. And consolidation might be one way to achieve that, so it might well be a good thing.
But as both of these guys have said, it's a high-touch business. And as I said earlier, you have a staff of 83,000 people around the world. In terms of delivering your wealth management to your people, how do you maintain that quality of excellence in that high touch, given the centrality of that to the wealth management sector?
So I think within each of our different businesses, we are extremely focused on what we do. So, if I was to speak about our UK private banking business, we serve less than 500 clients with a boutique team here in London, which are incredibly focused on what they do. The target market is very, very clear. That is part of a larger global wealth management business, and our clients look for that type of exposure and opportunity from our global business, particularly as it touches upon Asia.
Okay, good. Thank you. Ian, good thing, bad thing for the industry, for the customers?
I think it's a good thing, but you need to think about consolidation by different groups of clients, as Grant was mentioning. So where I think consolidation will benefit is at the affluent client, where you can start to standardize a little bit more advice and investment products. Consolidation probably won't work so well if you're a sort of specialist private client advisor, because as Charlotte has said, it's very, very difficult to scale advice. So I think it's a good thing in the sense that the private equity is mostly focused on the affluent sector and the lower high net worth. You know, what we'll see is possibly the industry will evolve like other industries that are fragmented, and we may move to a barbell concept. The barbell concept is you have a fewer big players, and you have lots of specialist players, and in the middle, which is a much harder ground, is the middle-sized players. And I think that's maybe how things will evolve. So consolidation can be good, but it's very dependent on the client segment focus.
Okay, Brent, so it looks like we've got a split jury on that one. Let's turn to consumer duty. As discussed, one reason for consolidation is the squeeze on firms' profits. Consumer duty, which came to force on the 31st of July last year, is, well, in a call the other day, I think, Charlotte, you said it took about a year to understand what was involved. So tell us, we'll begin with you. How has it affected what you guys do at CapGen?
Yeah, consumer duty has actually been a real conundrum for us because, in actual fact, when we look back, we realise we built the firm 20 years ago around what the consumer duty actually is. Little did we know. But that involved building a firm which is not scalable necessarily, other than by growing the business and new clients in that way. Not scalable by taking out cost, because it's focused on, there's no product to sell, it's focused on a holistic service to clients, and it's focused on complete transparency. So we built the business that way, which does actually mean that we serve clients in the way that we think that clients should be served. So when we see the consumer duty coming along, and it kind of encapsulates all of those principles, we're big cheerleaders for it. However, ironically, we're not actually covered by the consumer duty because all of our clients are professional, and where they're not professional, they're covered by some other threshold. That's the bit that took us a year to understand. So I think that's a challenge for all of us in the industry and the FCA, that, you know, we're highly supportive of those targets and goals within consumer duty, but it can't be right that it takes a business like ours a year to understand if we were going to be affected. Are we already in line with it? Yes, we are, but it turns out we're not affected. So you sort of go around in this big loop of regulation, and I do think it just simply does add cost when you've built a business along the original private banking paradigm, because that's not based on the consumer duty. So I think it's a very ambitious goal, but it will be expensive to retrofit the goals of the consumer duty onto businesses which were simply not designed to serve clients in that way. Now, it's disappointing that so much of the industry needs the consumer duty imposed upon it in this way, but I think it's no bad thing. It's just frustrating for those of us who are cheerleaders for it, that it is expensive and challenging even to understand.
Of course, it's easy to be a cheerleader when it doesn't apply to yourself, isn't it? Now, I'm sure, Grant, you didn't need to have consumer duty imposed on Standard Chartered's operations in the UK, but what's its impact been, and do you welcome it?
So it has made some very interesting conversations, and there are specific tenets of the consumer duty that raise eyebrows. Speaking to the board on an annual basis, seeking their attestation that they're compliant with consumer duty, and it must be the main bank board, which, that's quite a challenging conversation to have for them to understand that the relatively small UK business, this is what it brings with it. So I think that is, that's been a journey for all of us. Look, for me, and I think you heard this through Charlotte's discussion, even though it doesn't apply, it's all about who's your target market and how are you serving them, and then what do you need to do to ensure that you're delivering good outcomes for those clients. As discussed previously, we're a business that serves ultra-high net worth clients out of the UK. They've all got more than $5 million with us. They are not all professionals. In fact, only a handful of them are. So, however, they come from the footprint markets of Standard Chartered around Africa, Asia, and the Middle East. So we've had to be very clear in what we do for those clients, how we serve them, and ensure that those clients advised from our London Advisory Centre are fully compliant with Consumer Duty. I think the final thing I would add to that is it's all about proportionality and, of course, understanding. As you heard from Charlotte, Consumer Duty was designed really thinking about mass market retail organisations where there is not a personal relationship with a client. All of the clients of certainly three of us on this stage are relationship managed by relationship managers, or as we call them, who know those clients one-on-one. So really, the requirements that we face, as opposed to building large technology platforms to prove and demonstrate that we're delivering good outcomes for clients, there's a proportionality involved in terms of how we demonstrate the good outcomes we are delivering and ensure that we are ultimately then compliant with Consumer Duty in a different way to perhaps how it's envisaged for a large retail organisation.
Okay, now, Ian, at Multrees, you work with, as I said earlier, 24 client firms that have 14,000 customers. So you must have seen a spectrum of responses to Consumer Duty and have supported that. And if you had to follow it yourselves, what's the impact been, from nightmare to not a bad thing, really?
Well, I think what you've got to think about is we're on a journey to improve standards around clients. And we've been on this journey for a long time. Sort of edged on by the regulator. We've had RDR, we've had treating customers fairly. Now we've got Consumer Duty. I think what we're seeing is a lot of our clients have professional investors or experienced investors rather than retail ones. But generally, what we're seeing also is that they're adopting it, as are we. And I think some of the key areas going forward will be around thinking about price that we charge to clients versus fair value. And I think we're also going to be improving communications to clients. I think there's a lot about product and service transparency. And so I think there's a lot we can do. And I think also what we're seeing around some of our clients is they are also looking for not just regulation to help increase standards, but also acting proactively to enhance standards. So I think that's what we'll see. And so we'll see this filter down. And I think Consumer Duty will have an impact. And remember this, the UK is in the lead on Consumer Duty. It will come shortly into the EU. So again, I think it's one area where the UK can lead in terms of experience, and other countries will look to us to see how it's implemented successfully.
But going back to what Rob Amsterdam was saying earlier about increasing barriers to market, when we spoke the other day, Charlotte, you talked about your concerns about a moat being drawn around incumbents within the wealth management sector and the difficulty of entering it, Consumer Duty being just the latest in the long run. How concerned are you about strangulation of the sector by regulations like this?
I think it is really difficult for new entrants now to come into the market, not just because of all of this regulation that we've spoken about. It's a huge curve for someone starting out at the beginning, but also because of things like, for example, the regulatory capital regime, which makes it actually very difficult, and I'm sure this is no one's intention, to invest in new employment, for example. So perhaps those of you who are not in our industry, for every pound you spend on a new employee, you have to put aside 25 pence in regulatory capital. And that's regardless of what function that person is undertaking. So if you want to hire 10 new people to help you serve your customer better in Consumer Duty, it costs you that amount plus 25%. But if you want to hire 10 new people to, flog nonsense products to the sort of general public, it also costs you the same. So there's no real incentive to do the right thing. And as I say, the main thing is I think it just makes it very difficult to enter as a new entrant. And I think, as someone said, actually the ownership model is quite important here. Where is your capital coming from? That is quite important. And you need enlightened investors who understand that sometimes you do just have to invest, and your profit margin is not necessarily going to increase as a result, but you need to invest to achieve a certain sort of escape velocity in order to grow and be in that sort of middle to large segment that we need in to serve these clients. Okay,
Ross, it's a multi-question to you then. How much of a headache has Consumer Duty been to you? How much cost is it given you didn't have before? And what do you think about it and the impact of other regulations on small firms like yours coming into the market and making a name for themselves?
There's definitely been challenges because the burden of proof of Consumer Duty is on you. So the work we've had to do to review every single process, to look at how we're doing things. But to a certain extent, and our COO said that she felt it had been written very much for us. And there's perhaps two examples of that, one of which is we charge all of our clients the same fees, which I think is quite unusual in the industry. So as they grow or add more money, they pay incrementally less, but it's the same fee sheet. And the other thing is when we set the business up, and this does sound a bit unusual, we spent quite a lot of time thinking about making it easy to be fired. As you hear in press and other areas where people have been trying to hold on to clients, we thought, how can we make it no cost, no complications? So we really have tried to put the client first. We're a business that was built by clients. As I talked about the ownership structure earlier, 17 of our clients are shareholders. So we've been very fortunate. But when I look at it as a whole, when Sheldon Mills and the FCA were reviewing, are they going to add to Principle 6, treating customers fairly, or are they going to build the new, as they ultimately did, Principle 12, Consumer Duty? A big part of that is about trying to rebuild confidence in our industry. And I think that is sadly still essential. And we often forget, we talk about our competitors here. Actually, we have two huge competitors in wealth management that either someone will do nothing or they will do it themselves. So I really do support it as far as let's try and rebuild confidence in the industry, in London as a financial centre, and let's ensure when people create wealth, they will come to one of our firms to be looked after.
Okay, brilliant. Let's turn to other forces at play. And with 5 minutes to go before I turn to you for questions, let's check that everyone's still awake. On July the 5th, there's every chance that a woman called Rachel Reeves will enter the Treasury for the first time. Can I have a show of hands for those who think that wealth management will be a healthier place to be 4 years after that moment? Yeah. Come on. Okay, a show of hands for who thinks wealth management will be a significantly worse place to be as a result. Very good. And everyone in the room thinking politicians have no impact whatsoever on the course of events. Everyone else? Okay, so all right, well, thank you for keeping your opinions to yourselves. You sleep very quietly, is all I'll say. Let's talk to the other forces at play. First of all, since we have the election coming right at us, I'll ask you all for 30 seconds or so each on what you think the impact of this Labour government will be, the little that we know of it, will be on wealth management as a sector. Charlotte, I'll start with you since you're closest.
Yeah, I'm fairly sanguine about it, actually, because I think, we probably all feel change is coming, and we've probably all thought that for a while. This has been a sort of very long, slow process, I think, not to prejudge anything, but I think that's probably where most of us are. But a long, slow process, we're perhaps at the beginning of the end of a long reign, which has been exemplified by a lot of own goals and a lot of external problems. So to be fair, I think it's been a challenging period. So I'm quite sanguine about a new government. I think we already have uncertainty about what's going to happen in the non-dom regime. There's always been uncertainty. We now have additional uncertainty, and there will still be uncertainty. I don't think that the potentially new Labour government are going to be able to, implement something super fast because they've got a lot on their plate. So I think we may still have another year or so after the election of sort of lack of clarity, but I think that's business as usual for us.
So we'll be talking about it for a while.
I'm afraid so.
Ross, a change is coming. Will it be winter or summer?
Well, I mean, listening to Rishi's speech yesterday, I pretty sure I heard him say things can only get better several times over, which I wasn't sure which way that was leading. I think we're in a position now where 50% of the global population are going to the polls this year. It's quite amazing. And of course, 1 billion of them in India. So there's a lot of change. But in the two major elections, of course, in the US, both of them have been presidents before, notwithstanding what Mr. Trump may do if and when he gets in. But I think we're here. We've seen such a big rush to centre. And Rachel Reeves has done an excellent job in speaking in the Mansion House, speaking at Davos. She has been trying to warm the city up. She's talking about the fact that she's looking to create the opportunity for investment and for innovation, while still trying to encourage stability. I think that it won't be too detrimental to what's going forward. I think she will do a reasonable job, assuming that they get in.
Brilliant. Grant, come on, if I can ask you to be quick on this since we're running short of time.
Very much echo what we've just heard. I welcome the engagement that we've seen with the city from Rachel Reeves. So I don't foresee any major change in policy as it will affect the city in the short term. I think, overall, though, the international competitiveness and attractiveness of the UK is something that we should be concerned about. But that's a statement I would have made prior to the election, and I'm sure afterwards.
Yeah, okay. Ian, quickly on that one, and then we'll move on.
I think we're at the pivot point now, and there will be change in the rankings of the wealth centres. So far, London is still ahead. There are many things to like about it. Unfortunately, our government doesn't, I don't think, fully understand wealth, and I think the future is in our hands, because I think we have to help the government understand that we're moving to an era of new industries, new entrepreneurialism, green tech, health tech, all these new areas. Huge amounts of wealth will be created. And currently, Switzerland is edging ahead and Singapore is edging ahead. So, we need a strategy for UK wealth. And I think that's in all of our hands to dialogue with the government on that.
Okay, let's finally turn to those, apart from Rachel Reeves, other forces at play in the sector. I'll ask you all to alight on one of them quickly, each, and then, which should mean not everyone will have something to say, and then we'll turn to questions from the floor. Ian, can I ask you to begin on the other forces, apart from the Labour Party, that are affecting industry? What's the most important one that you can identify?
Well, I think a big structural trend is one we've already mentioned, and it could have great potential for us going forward, and that's AI. It could be a game changer. You need to think about AI in conjunction with data and cloud. And, as we go forward, what it will allow us to do, it's a technology that allows us to be more predictive and understanding in terms of client insights. It allows it to work at increased levels of speed. It allows us to move to data-driven management, which was mentioned, I think, earlier. It enables us to increase operational productivity, helping our margin pressures. But there are huge risks that need to be managed, hallucinations, bad actors, and so on and so forth. I think it will come, and it will be in conjunction with other technologies, as was mentioned earlier. So I think technology could be a saviour for industry and for all of our models, including the larger players and the mid-tier and the smaller players.
Okay, brilliant. Grant, you're next. So,
global flows of wealth.
Yeah.
I think we saw some stats over the last couple of days. The Chancellor delighted with 0.7% growth being hit in the UK. China still growing in the mid-fives. So I think we'll continue to see new wealth created in Asia, and that will flow. Where will it flow to? Well, that's, as we're discussing, something that we should all be concerned about, and will we capture our fair share here in the UK? At the same time, of course, there are reverse flows. So once again, UK, European, Middle Eastern families looking very much wanting to participate in that Asian growth story. So those flows of wealth that we see, where it's being created, where it's being held, where it's being invested, I think is key.
So presumably Lincoln's keen to capture as much Asian money as possible, Ross.
We're really focused on the UK, so we have very much international client base, but our bigger focus on the UK. But if I were, since I can't pick AI or global flows, I think if I were to pick one, I think it is about responsible investing and sustainable investing. It's become a much bigger thing over time. Clearly, we're in a specific period now where we're stepping back from our sort of carbon emission targets, where there's concerns about, rightly, around greenwashing, but we see it particularly from the next generation of our clients, that it is very important. I mean, we've been signatories of the UK Principles of Responsible Investing for some time, and recently became B Corp, but we're not focusing on being leading as an ethical business, but what we do need to be able to do is explain to our clients the impact of the investing that they are making. So they can make their own choices, but we need to be in a position to explain what they're doing.
People have been talking about sustainable investing for a long time. So of all the things on the charge sheet facing us, you picked that because why are you picking it? How to talk to it? Because it is important. We know it's important, but
because it is linked to this sort of intergenerational change, which is perhaps the other part, is we see the wealth transfer from the baby boomers to the next generation as a huge part of what we see in our business. So we are seeing this next generation of wealth coming through, and they have a significantly greater focus than perhaps the wealth creators themselves had on whether it's as far as philanthropy, but normally about investing responsibly.
So as well as the interpersonal issues of the next gen, it's also their fascinations. Charlotte.
Well, I would say next gen, and their increasing interest in this side of investment activity. I think one of the challenges for businesses like ours is actually when you really go under the bonnet of, for example, ESG investing, it's actually incredibly boring. I mean, like a lot of what we do, it's just boring nuts and bolts of sort of detail and attention and all of those things. So it doesn't necessarily win the hearts of your next gen clients. They sort of come in very excited and interested in it, and then actually discover it's just another risk metric that we have to apply. So I would say one of the challenges is to keep the energy up on this area, because otherwise it just becomes a tick box exercise. The other change in sort of demographic I would note is we have an increasing pool of entrepreneurial clients. So our heritage was sort of in legacy clients with lots of trustees and lawyers and advisors, and now we have people who've made a lot of money very, very quickly, usually in some sort of tech-related business, and they want to be served in a very different way. And that is actually a challenge for us to adapt to the way they want to be served. They want wealth management done in a slightly different way. They have slightly different goals and objectives, and so that's a challenge for us. And I hope if London can retain some of its sort of status, we can continue to attract those kind of clients. But that is something that I think I would want Rachel Reeves and a potential Labour government to really focus on, is how do we keep entrepreneurs in this country?
And is it your sense then that entrepreneurs are more high maintenance in their demands as customers?
That's a nice way of putting it.
Okay, but that probably puts the stress upon the whole industry, because if your clients are more demanding, then you've all got to get better at what you're doing.
There's a degree to which they're more demanding, but there's also a degree to which they're asking us to just serve them something slightly different than what we perhaps were used to. So just as an example, for some of our clients, a capital preservation portfolio makes no sense because there's a huge dividend coming out of the business every single day. So we are having to adjust how we understand their needs. And again, it's back to having RMs and having relationship managers who can really listen and watch the clients as their lives change. And their lives are changing month on month. So it's a demand on us, but it's one I think is sort of good for us to get better at.
Brilliant. Let's turn to some questions from the room. I have got a little glitch with my Slido document here. So we're going to do it the old-fashioned way. So let's have a hand, please. I feel like an auctioneer all of a sudden. And a mic can come to you, or perhaps you could project. Do you have a question for anyone, please? Sir.
Yeah, hi there. I think it's safe to say that we're in an environment of higher interest rates for longer, or longer than we expected. In terms of that backdrop, high risk reward, how can you still add value to clients?
Okay, how can you add value? How can you add value to clients in this enduring high interest rate environment? And I suppose we could add with inflation being more resilient as well. Grant first, come on.
duration and reinvestment risk, I think, is the discussion that we're having with clients at the moment. So you're absolutely right, higher for longer, and how much longer, that's obviously the question on clients' minds. You know, again, I think conversation yesterday, one rate cut in the UK by year end, I think, is now what most forecasters would say. However, at some stage, these rates are going to come off. When they do, what sort of coupons are you going to be achieving on the back of that? Have you got used to achieving coupons at a higher level than what you're going to be receiving in 12 months, 24 months' time? And is now the time to start thinking about, do you look at other investment opportunities in order to maintain the types of coupons that you've been achieving by simply having money on term deposit for the last couple of years? So I think that's the conversation that we're trying to have with clients and make sure that they're ensuring that the types of coupon cash flow that they're seeing will be in place into the future.
Thank you. Ross, that ring bells for you?
It does, yes. And I just comment on the entrepreneurs from earlier. I think, you know, for our clients are predominantly entrepreneurs. They are generally sophisticated, they've built their own businesses, not necessarily financially sophisticated. But I think the biggest challenge is we consider them the most reluctant to relinquish control. So that's sort of part of building that trust and building the relationship, but satisfying when you manage to. So yes, you know, the interest rate environment, we started at the beginning of the year with an expectation of 4.5 rate cuts during the year. Last week it was at 2.2 rate cuts. It's turned yesterday to 1.6 rate cuts. So it is likely, and it's certainly our view, that both inflation, as commented on earlier, will be a bit stickier that last part, and therefore interest rates will have to remain higher for longer. It brings with it lots of challenges, but actually it's given the first opportunity in 15 years for people to buy government bonds and get a very good yield. So I talk about the competition of people being able to do other things. Clients with a lot of wealth have been able to buy government bonds and get a 7-8% gross equivalent return. So why not just do that when it's risk-free? That trade will not be around, so inflation is coming down, interest rates will come down, it will just take a lot longer, and then people will need to invest. So we think there's opportunities in the world. I think it's important, as was commented on by our previous speaker, to be dynamic, to be diversified, but there are opportunities, and unfortunately you're not going to be able to sit in cash forever.
Great. So, Charlotte, there are opportunities and you can't stay in cash.
You can't stay in cash forever. I think people do have quite short memories, particularly perhaps the entrepreneurial group who've got survivorship bias built in because they've taken a lot of risk and it's paid out for them every time. So there's a tendency, I think, to think, well, you can throw money in the equity market and it will just be kind of upwards only because it has been for the last 2 years. You know, you can park money in cash and it will return you 5%, and you know, really, why would anyone bother with a portfolio manager? So I think you know, people do have short memories around this, and actually what we're seeing as interest rates, I think, do remain higher for longer, is that it actually winnows out some of the less sort of satisfactory long-term solutions. So we know that private equity, for example, clearly has had, you know, a little bit of a sand in the engine because of this higher interest rates. But that doesn't mean that private equity won't continue to be an important place for investors to use over the long term, but it means actually private equity now, we have one client who is new to private equity and approached individually a whole range of private equity funds, expecting to get a no from everyone, and they got a yes from everyone, and that's just not what they were expecting. But for a client, that's a bad sign. You know, it should be hard to get into this asset class. Private equity funds are used to being very picky about who they have as clients. So that means for those clients, they need to understand you need to be very discriminating at this point. And if you are very discriminating at this point, you will be able to make better choices than you could a year ago. Okay, brilliant. Now, over at Multrees, may I ask, how is the high interest rate environment impacting your clients, and what are you observing them doing en masse?
Significant change in the clients moving forward. You know, I'll pick up on a couple of points. One is the rise of the entrepreneurs. So think about these entrepreneurs are first generation. So one of the things you can offer is the combination of intellect and network. an experience in terms of helping these entrepreneurs manage their wealth going forward, as was mentioned. So we're starting to see shifts in the new model family offices. You're starting to see shifts in the new model private investment offices going forward. And you know, we're on the cusp of this big change, a structural change I talked about earlier, the rise of private assets and other new investing classes.
Brilliant. Well, that brings us to the end of our time. Thank you very much for listening and taking part. We now have a 25-minute break for coffee, and we'll be back here at 11 a.m. But please could you join me in thanking our eminent panel for their time. Thank you, guys.